A single reporting mistake could now cost you up to $10,000 per violation, even if you never intended to do anything wrong. And for many people living in the United States, that risk is tied to something they barely think about anymore: a bank account overseas. If you are a U.S. citizen, green card holder, or long-term resident, and you still maintain savings, investments, or any type of financial account outside the United States, recent enforcement updates have made it more important than ever to understand your reporting obligations. This is not limited to wealthy individuals with complex offshore structures. It applies to ordinary immigrants, retirees, students, and families whose financial lives span more than one country. Many people assume that if an account is small, inactive, or rarely used, it does not matter for U.S. tax purposes. Others believe that if they already filed their annual tax return, their responsibilities are complete. Unfortunately, those assumptions can lead to unintentional noncompliance. What makes this especially concerning is that most violations are not deliberate. They happen because people were never clearly informed that certain foreign accounts must be reported separately, even if they generate little or no income. Understanding what changed and how the rules apply to you is essential if you want to avoid unnecessary penalties and protect your financial stability. I focus on breaking down complex immigration and financial compliance updates into clear, practical guidance so you can stay informed and fully compliant without feeling overwhelmed. If you have worked hard to build your life in the United States, paid your taxes, and tried to follow the rules, the last thing you expect is to face a penalty over an account you may have opened years ago in another country. My goal today is to explain what the IRS has clarified, who is affected, and what steps you can take right now to stay protected. The core reporting requirements for foreign financial accounts have existed for years. What has shifted recently is the level of enforcement, clarification of penalties, and broader application of expectations across different types of taxpayers. The IRS has reinforced that foreign account reporting is not limited to high net worth individuals. It applies to anyone who meets the statutory thresholds, regardless of income level or immigration background. Even modest accounts can trigger reporting if they cross certain limits at any point during the year. There is also greater coordination between U.S. authorities and foreign financial institutions. Through international data sharing agreements, more account information is now exchanged across borders. That means foreign accounts are increasingly visible within the global compliance system. In addition, guidance has clarified how penalties may be calculated for non-compliance, including how violations can apply per account and per year. This clarification has made it clear that even unintentional errors can carry meaningful financial consequences. At the center of this issue is a reporting requirement commonly known as the FBAR, or Report of Foreign Bank and Financial Accounts. This is not filed with your standard tax return. It is submitted electronically to the Financial Crimes Enforcement Network if the aggregate value of your foreign financial accounts exceeds $10,000 at any point during the calendar year. The phrase "at any point" is critical. Even if the combined balance only briefly exceeded $10,000 for a single day, the reporting requirement can still apply. Many people mistakenly believe the threshold applies to each account separately, but the rule looks at the total value of all qualifying foreign accounts combined. Qualifying accounts may include checking accounts, savings accounts, brokerage accounts, certain foreign retirement accounts, and in some cases, accounts over which you have signature authority. It is not limited to accounts that generate taxable income. The focus is on financial interest or control. Separate from the FBAR is Form 8938, which is filed with your federal income tax return under the Foreign Account Tax Compliance Act. The thresholds for Form 8938 differ based on filing status and residency, and they are generally higher than the FBAR threshold. However, filing one does not automatically satisfy the requirement for the other. For example, a single filer living in the United States may need to file Form 8938 if specified foreign financial assets exceed $50,000 at year-end or $75,000 at any time during the year. Married couples filing jointly have higher thresholds, but even if Form 8938 is not required, the FBR might still be. These overlapping requirements create confusion. Many taxpayers file their annual tax return and assume their obligations are complete, unaware that a separate electronic filing may also be required. That gap between assumption and requirement is where many compliance issues arise. When it comes to penalties, the law distinguishes between non-willful and willful violations. A non-willful violation typically means the failure to file was due to negligence, inadvertence, or a misunderstanding of the rules. Even in those cases, penalties can reach up to $10,000 per violation. A willful violation, by contrast, involves a voluntary or intentional failure to report. In those cases, penalties can be significantly higher, potentially reaching the greater of $100,000 or 50% of the account balance per violation. The difference between non-willful and willful can depend on facts and circumstances. Another important factor is how violations may accumulate. If multiple accounts were not reported, or if required filings were missed across multiple years, penalties can compound. This is why early awareness and correction are so important. Some people wonder how the IRS would even know about an account overseas, especially if it has not been actively used. The answer lies in international financial transparency agreements. Many foreign banks now report certain account information connected to U.S. taxpayers, which can be shared with U.S. authorities. This increased data visibility does not mean that honest taxpayers are automatically targeted. However, it does mean that relying on the assumption that a foreign account will go unnoticed is no longer a safe approach. The people most affected by these rules are not a narrow group. Green card holders who maintained bank accounts in their home countries before immigrating often fall within the reporting thresholds. Over time, those accounts may grow or fluctuate in value without much attention. Naturalized citizens who inherit investment accounts abroad can also face reporting obligations, even if they are not actively managing the assets. The key issue is ownership, financial interest, or control, not the frequency of transactions. Retirees receiving foreign pension payments or holding retirement accounts overseas may also be required to report those accounts if the value crosses applicable thresholds. Even if distributions are modest, the account balance itself can trigger reporting. Joint accounts with family members are another common situation. If your name is on the account and you have signature authority, you may have a reporting obligation even if the funds primarily belong to someone else. International students supported by parents through overseas accounts, or small business owners with occasional foreign financial ties, can also find themselves within the scope of these rules. The common thread is access, control, and aggregate value. If you are unsure whether these rules apply to you, the first step is to review all foreign financial accounts connected to your name or signature authority. Think broadly. Include older accounts, joint accounts, inherited accounts, and retirement accounts abroad. Next, gather documentation. Obtain statements that show the highest balance during the year. Confirm account numbers and the name and address of each financial institution. Accurate information is essential for proper reporting. Then compare the aggregate maximum balance of all qualifying accounts to the relevant thresholds. Remember that the FBAR threshold is based on the combined value at any point during the year. If you discover that prior year filings were required but not submitted, do not panic. In many cases, there are procedures available for taxpayers to correct non-willful errors voluntarily. Acting before receiving any official notice generally places you in a stronger position. Timely, proactive correction demonstrates good faith. Waiting and hoping an issue never surfaces can increase risk, especially in an environment of expanded data sharing. You should also consider seeking guidance from a qualified tax professional with experience in international reporting. If your situation involves multiple countries, complex assets, or uncertainty about ownership or control. Going forward, maintain organized records of foreign account balances each year. Keep copies of any filed reports and related documentation. Consistent record-keeping transforms compliance from a stressful event into a manageable annual process. Ultimately, 3 key principles can help protect you. First, understand that foreign account reporting is triggered by thresholds and control, not by how important the account feels to you personally. Second, Recognize that many mistakes are correctable when addressed early and in good faith. Third, make it a habit to review your global financial footprint annually so nothing is overlooked. The purpose of understanding these rules is not to create fear, but to provide clarity. Most people affected are simply navigating life across borders while trying to comply with complex systems. Everything discussed here is intended for general informational purposes. Individual circumstances vary, and even small differences in residency status, account structure, or ownership can affect specific obligations. For advice tailored to your situation, consult official government resources or a qualified tax professional. By staying informed, organized, and proactive, you can protect your financial stability and remain fully compliant while continuing to build your life in the United States with confidence.